Hey everybody, Andy Doutrick with Centennial Lending Group back again to talk a little bit more about total cost analysis and how it helps our borrowers make good informed choices about their investment of real estate. And so today I wanted to talk a little bit about reinvesting savings into your mortgage balance. And so a lot of times, especially with first-time home buyers, we'll run into folks that try to get a little too aggressive with their amortization schedule and take out a 20-year loan or a 15-year loan, which is great. But the challenge with those loans is if you have any type of significant life event that requires you to divert money to another source, you're stuck making that larger payment. So if we think about the average length of a mortgage in the United States, it's about 7 years. Not the average length of home ownership. The average length of a mortgage is about 7 years. The reality of anybody paying off a 30 or a 20 or a 15-year loan statistically doesn't usually happen. So when I have someone that's interested in taking out a shorter term loan to pay it off quicker, what I'll do is I will show them the options that they want to see. And in this case, this couple was looking for a 20-year mortgage. So I showed them the 20-year amortization, but I also showed them a 30-year amortization at a higher interest rate. I showed them a 30-year amortization at a lower interest rate. And then what we did was we looked at a reinvestment strategy, meaning the payment difference on the lowest payment was about $700. Okay, so $700 different than the highest payment on the 20-year loan. So what we did was we said, okay, well, what would happen if we took that $700 and reinvested it every month to pay the balance of the mortgage down sooner, knowing that if we needed that money, we could keep it. We wouldn't be obligated to make that payment. And so we took that $700 and we diverted it to the mortgage every month, assuming they could do that faithfully for a 60-month period, so about 5 years. And what we saw was it actually cut down the freedom point on that 30-year mortgage in the first 5 years by another 5 years. So we're getting close to matching that 20-year amortization. And when we go out of the reinvestment screen and down to the interest paid over that same 5-year period, you can see that the only loan that's even close to having that interest paid off sooner is the 20-year amortization with the slightly lower interest rate. But the interest rates are about identical. And when we go into the long-term analysis screen and we look at the loan balance, we actually have a lower loan balance with the 30-year amortization schedule than we do with the 20-year loan, even though the interest rate is about an eighth lower on this 20-year product. So when you're considering a mortgage and your loan officer wants to talk to you about taking the longest term, it's not for their benefit. We don't get paid based on the length of the loan that you take out. But we've seen time and time again how borrowers will get too aggressive with their mortgage and then they have a significant life event like a job loss or a death in the family or a birth or something that requires them to divert funds in another direction, coming back to us to refinance again because the plan didn't work out. So reach out, get that total cost analysis done, look at all your options and make a good solid choice, not just based on the numbers and what you think will happen, but based on the life choices that face you in the next 3 to 5 years. If you have any questions, you can reach out at andyloan.com. Have a great day.